The US dollar extends losses as sterling and the yen rally before the much important US inflation data due later today. So the US inflation is expected to have eased to 3% level, but sticky core inflation in the US and that sticky robustness in the US jobs market will unlikely to convince the Federal Reserve hawks to back off, even with a soft headline figure today. So welcome, this is Swissquote's Daily Market Talk. So yesterday was an interesting day in the FX markets. The US dollar extended losses after breaking a long-term ascending channel base yesterday as the British pound actually rallied on yet another stronger than expected and quite a strong wages growth data released yesterday morning in the UK. So average weekly earnings in Britain, excluding bonuses, increased 7.3% in the 3 months to the month of May. And although the unemployment rate in Britain ticked up to the 4% level, it was said that it was because more Brits actually started looking for jobs, and it wasn't because people just lost the jobs that they already had. Now, don't be jealous of Brits that actually get such a good jump in their pays, because well, inflation in Britain is still hot and hotter than the other places in the Western world. The average mortgage rate in Britain rose to 6.6% level, so that's the highest level since 2008. Inflation in Britain is sitting at around 8.7% level, and according to Truflation, while prices grow at a speed that's faster than 11% in the UK. The thing is, obviously the robust wages growth partly explains why the Bank of England is having so much pain fighting inflation in the UK, and that's also why yesterday's data actually fueled the expectation of another 50 basis point hike from the Bank of England in its next monetary policy meeting. And that's pretty much what should happen if the UK rate should reach 6.5 or 7% range by the first quarter of next year, right? As predicted by many analysts out there. So yesterday, the news of higher wages growth gave a jolt to the British pound. Cable hit 1.297 level yesterday, the highest level since April last year. But whether this rally could continue will depend on one, where the US dollar will be headed after today's CPI data in the very short run, and two, where the UK economy is headed if the Bank of England hikes rates towards the 6.5 and 7% range in the longer run, because the Bank of England's rate hikes will continue pressuring the British housing market and the British growth to the downside, and that could obviously limit cable's topside potential following a knee-jerk positive reaction to the hawkish Bank of England expectations. So we will see what happens. But as I was saying just before, well, the short-term direction in cable and the short-term direction in other currency pairs will mainly depend on the US dollar today, after the most important CPI data is released in the US later in today's trading session. Now, the consumer price index in the US is expected to have eased to around 3.1% from around 4% printed a month earlier. So that's chic. It's a great retreat in the headline inflation for the US, but unfortunately, it won't be enough to convince the Federal Reserve to back off from further interest rate hikes in the coming meetings, because the further fall in the US headline inflation toward the 3% level is again due to a favorable base effect on energy prices, which, remember, fell sharply since the peak that we saw following the shock that we had at the start of the Ukrainian war last year. But what's important here is the core inflation, and the core inflation in the US is expected to remain sticky at around the 5% mark. So that's still more than twice the Federal Reserve's 2% monetary policy target, and that still demands a further monetary policy tightening from the Federal Reserve moving forward. Plus, the rebound in oil prices these days actually hints that the risk of an uptick in the headline inflation in the US and elsewhere in the world is also building stronger for the coming months and the coming meetings. The barrel of American crude actually rallied past its 100-day moving average at yesterday's trading session and is now flirting with the $75 per barrel level this morning at the time I'm talking here. And trend and momentum indicators remain positive, comfortably positive, and we are not in overbought territory just yet, meaning that this rally could further develop. The next natural target for the oil bulls now stands at the 200-day moving average level that stands near the $77 per barrel level. And in percentage terms, we are now talking about a 12% rally since the start of this month, and the rebound that we see is obviously a response to the further production restriction from Riyadh and Moscow that are actually very much determined to push these oil prices to at least $80 per barrel level and above. And it's also due to Beijing's stepping up efforts to boost the Chinese economy by a significant bias towards easing the Chinese monetary policy, decreasing delays and completing the falling race by fresh stimulus in fresh fiscal stimulus in sectors that are the most in need, like the Chinese real estate sector, for example. But despite the lower supply from OPEC and despite news of fresh monetary and fiscal stimulus from China, I still think that we will see a solid resistance into the $77 per barrel level, as yes, in one hand, OPEC Plus is cutting its supply to boost energy prices, and their supply cuts will obviously dampen the global oil glut in the second half of this year, even more so if China finally achieves a healthier recovery path. But on the other hand, the Chinese recovery is not a one game just yet, because so far the stimulus measures just didn't work out well, while increased oil output outside the OPEC cartel helps keeping the price pressure contained in the oil markets, as American crude production is, for example, on track for a record year this year, and half of the new crude that's coming towards the global markets is coming from the US, where companies like Devon Energy, for example, deliver strong output, and that thanks to their improved efficiency. So all we hope in the actual context is that the energy and commodity rally remains somehow contained, and that for the sake of global inflation and sake of central banks and central bankers. Now, for now, we have some good news on the central banks front. The Reserve Bank of New Zealand actually kept its policy rate unchanged at 5.5% mark when it's met today. So they hiked for 12 straight months, and now they're coming to an end. So that's a sign that the actual rate tightening could be gently coming to an end in New Zealand, even though nothing actually guarantees that the central banks that actually pose hikes won't start hiking the interest rates again in the future. It all depends on inflation, of course. Now, later today, the Bank of Canada is also expected to go ahead with what could be a final 25 basis point hike in this tightening cycle in Canada as well. The Federal Reserve, however, on its end, is seen hiking 2 more times in the coming months, as the strength of the US jobs data combined with strong economic data and little pain on the US housing market thanks to lifelong mortgages is still pushing the Fed to do more. So all we have to do is now to pray for the US jobs market to loosen at least a little bit, and inflation in the US to fall. Now, it's still very interesting actually to see the US dollar fall, while there is nothing on the Federal Reserve's front that actually hints at any softening in the Federal Reserve's hawkish policy stance moving forward. That and the fact that we will soon be flirting with oversold market conditions in the US dollar actually hint that we could somehow see a rebound and a correction in the greenback in the coming hours and days, if of course backed with robust core inflation read and strong economic data from the US, in the sense the USD CAD, for example, is testing the 1.32 support this morning, where the loonie is boosted obviously by better oil prices these days, and the dollar yen slipped below its 50-day moving average yesterday, and it also slipped below the 140 psychological level. And in case of any disappointment on the US core inflation front today, I expect some reversal in these US dollar losses. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your messages. I hope this episode of Market Talk has also been helpful and insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. And follow us on Instagram, on Twitter and on LinkedIn for regular market updates. And subscribe, of course, to our YouTube channel for daily market comments. I will meet you again tomorrow. And until then, good day trading.